Imagine two friends. They graduate from university on the same day. They get jobs at the same company, earn the same salary, live in the same city. Neither wins the lottery, neither inherits money, neither starts a billion-dollar company. Yet, 30 years later, one quietly becomes financially independent. The other is still worried about money, still working, still wondering where all the years went. So, what happened? The answer wasn't how much they earned. It wasn't luck. It wasn't intelligence. It wasn't timing. It was one simple financial decision, made over and over and over again. Today, we're going to compare two ordinary people. One chose a savings account. The other chose investing. And the difference is larger than most people ever imagine. Same job, same salary, different decision, different life. If someone asked you, where's the safest place for your money? Most people would probably answer, the bank. And they're not entirely wrong. Banks provide security, convenience, liquidity, and for your emergency fund. A savings account is one of the best tools available. But here's the question almost nobody asks. Safe from what? Because while your balance may never go down, your purchasing power might. Imagine placing $10,000 inside a savings account. You check it every month. The number grows, slowly, comfortingly. It feels like progress, but outside the bank, the world keeps changing. Groceries become more expensive, housing costs rise, fuel prices increase, healthcare becomes costlier. Your money may still be sitting safely, but its ability to buy things is quietly shrinking. This invisible force has a name, inflation, and unlike market crashes, it rarely makes headlines because it works silently every single day. Imagine leaving an ice cube on a kitchen table. You return several hours later. No one touched it. No one stole it. Yet, it's smaller. Eventually, it's gone. Inflation works the same way. No dramatic alarm. No notification. No breaking news. Just a gradual erosion of what your money can buy. If inflation averages around 3% per year, $1 today won't buy the same amount 10, 20, or 30 years from now, which means doing nothing is actually a financial decision, one that quietly carries a cost. Economists call this opportunity cost. It's not just about what your money earns, it's also about what it could have earned had you used it differently. Let's meet James. James is responsible. Every payday, he transfers money into his savings account. He avoids unnecessary spending. He rarely misses a deposit. His bank app shows steady growth. Every month, the number increases. James feels proud. He's disciplined, organized, consistent, and honestly, those are wonderful habits because saving money is the first step toward financial health. But James has one belief that millions of people share. If my money never goes down, I'm doing everything right. Is he? Let's find out. Character profile. Age 25. Salary average. Monthly savings consistent. Financial personality. Careful. Risk averse. Disciplined. Now meet Sarah. Sarah also saves money, but she treats saving and investing as two completely different jobs. Her emergency fund stays in a savings account because emergencies don't wait. But everything beyond that is invested, not in lottery stocks, not in overnight riches, not in internet hype. Instead, she invests regularly, month after month, into broadly diversified assets. She understands something James doesn't. Money isn't just meant to be stored, it's meant to work, even while she sleeps, even while she's on vacation, even while she's at work. Her dollars become tiny employees, working every day without asking for a paycheck. Savings account, protection, emergency fund, liquidity, investment portfolio, growth, ownership, compounding. Fast forward 10 years, James opens his banking app. His savings account has grown steadily, predictably, comfortably. Sarah opens her investment account. Some years, it went down. Some years, it surged. There were frightening headlines, market corrections, economic uncertainty, moments when she questioned whether investing was worth it. But she kept going because she wasn't investing for this year. She was investing for decades. And that's where everything begins to change. The greatest advantage wasn't earning more. It was giving time the opportunity to multiply. Here's something fascinating. The biggest enemy of investing isn't volatility, it's emotion. When markets rise, people feel brilliant. When markets fall, they feel terrified. Many sell at exactly the wrong moment, not because investing failed, but because fear took control. James never experiences those emotional swings. His balance looks stable, predictable, comforting, and psychologically, that feels safe. But comfort and wealth are not always the same thing. Sometimes, the greatest financial risk is avoiding all visible risk while quietly accepting an invisible one. Psychological contrast. James sleeps peacefully. Sarah ignores market headlines and continues investing automatically. Years continue passing. Right now, many viewers are probably thinking, so, which one actually ends up richer? We're about to compare their money year by year. Not opinions, not guesses, actual mathematics. Because what happens over the next 20 years is where this story becomes truly astonishing. The numbers are about to reveal why one financial habit can quietly cost hundreds of thousands of dollars over a lifetime. Let's go back to James and Sarah. They both started at age 25. They both decided to set aside the exact same amount every single month. Neither contributed more. Neither earned a higher salary. The only difference was where the money went. James placed his monthly savings into a savings account. Sarah invested the same monthly amount into a broadly diversified portfolio with a long-term mindset. Now, before we continue, one important reminder: no investment is guaranteed. Markets rise, markets fall, returns vary. The numbers you're about to see are illustrative examples, not promises, but they demonstrate one of the most powerful forces in personal finance: time. Illustrative example: same monthly contribution, same time period, different strategy. At first, the difference is surprisingly small. 5 years pass. James feels confident. His savings account keeps growing. Sarah's investments have experienced ups and downs. Some months, her balance is lower than the month before. If you only looked at those early years, you might even conclude that James made the better decision. But then, something remarkable happens. Not because Sarah starts investing more, not because markets suddenly become perfect, but because growth begins generating more growth. The returns start earning returns of their own. This is the quiet engine behind long-term wealth. Compounding. Imagine standing at the top of a snowy mountain. You make a tiny snowball, hardly impressive. You give it a gentle push. At first, it barely grows, but as it rolls downhill, it gathers more snow, more weight, more momentum. Soon, the snowball is growing because of everything it has already collected. Compounding works the same way. In the beginning, your monthly deposits do most of the work. Later, your accumulated growth begins doing more of the heavy lifting. Eventually, your money starts working harder than you do. Many people fear market volatility, but history suggests that for long-term investors, volatility has often been the price paid for growth. Temporary declines can feel uncomfortable, but inflation quietly reduces what idle cash can buy year after year. The lesson isn't that everyone should invest every dollar. It's understanding that every financial tool has a different purpose. Savings protect, investments seek long-term growth. Confusing those roles can become an expensive mistake. Every investor eventually asks the same question: what if the market crashes? It's a reasonable concern. History has seen recessions, financial crises, bear markets, unexpected shocks. But history has also shown that markets have repeatedly recovered over long periods, although no future outcome is guaranteed. That's why experienced investors often focus less on predicting next month's headlines and more on staying invested through decades, because missing just a handful of the market's strongest recovery days can significantly reduce long-term results. Consistency often matters more than perfect timing. Now imagine two more friends. One begins investing at age 25. The other waits until 35. Both eventually invest the same amount every month. Who wins? Most people assume the person who invests more money, but often the advantage belongs to the person who simply gave time a 10-year head start. Money can be replaced. Time cannot. The greatest loss isn't always losing money. Sometimes it's delaying the moment your money begins working for you. By now, you might be wondering, so should I empty my savings account? No, not at all. Financial security isn't built by choosing between saving or investing. It's built by understanding when each one belongs. Your emergency fund belongs somewhere stable and accessible. Money needed soon for rent, medical expenses, or unexpected repairs generally shouldn't depend on short-term market movements. But money set aside for goals many years away may benefit from having the opportunity to grow. The smartest investors don't replace saving, they build on top of it. Emergency fund savings, long-term goals investing, near-term spending cash, retirement long-term investing. So, who became wealthier? James or Sarah? James wasn't careless. He was disciplined, responsible, consistent. Those habits deserve respect. But Sarah combined those same habits with long-term investing. She allowed time, discipline, and compounding to work together. The shocking difference was never about intelligence. It wasn't about taking reckless risks. It wasn't about finding the next hot stock. It was simply understanding the different jobs that saving and investing are designed to do. Perhaps the most important question isn't how much money do I have? It's this: is my money doing the job I expect it to do? Is your savings account protecting your emergency fund? Excellent. That's exactly what it's designed for. Is your long-term money positioned to pursue growth over many years? If not, today might be the perfect time to start learning, not because investing guarantees wealth, but because understanding how money works can change the choices you make for decades to come. Financial freedom rarely arrives through one spectacular decision. More often, it grows from hundreds of ordinary ones. The transfer you automate, the budget you stick to, the fear you refuse to let control you. Saving protects your present. Investing helps prepare for your future. Neither is the enemy. Both have a purpose. The real question is whether your financial plan gives each one the right role Because one day, your future self will look back on the choices you make today and quietly say, thank you. Don't let your money sit without a purpose. Protect what needs protecting. Grow what has time to grow. Remember, wealth isn't about predicting the future. It's about preparing for it, one thoughtful decision at a time. Until next time, keep learning, keep growing, and invest with wisdom. Subscribe to Lily Invest for calm, practical investing explained simply.